Most new traders spend years drowning in 100 different chart patterns, each one promising to be the secret. Head and shoulders, double tops, bull flags, falling wedges, cups with handles, and the list of shapes goes on forever. But the traders who actually survive long enough to make real money quietly ignore almost every single one of them. Because underneath all of those fancy shapes sits one simple idea that silently runs the entire stock market. That idea is called support and resistance. And once a trader truly sees it, they can never unsee it again. This one concept explains more about why prices move than every complicated indicator ever stacked on top of a chart. So the real question is why this boring pair of lines matters more than every flashy pattern combined. To understand that, a person first has to stop seeing a price chart as a screen full of random squiggles. A chart is not really a picture of a stock at all. It is actually a picture of human behavior. Every candle on that screen is a frozen record of thousands of people making real decisions with real money. Fear, greed, regret, and hope are all sitting right there inside the price if a trader knows how to look. And that is where the honest version of this lesson has to begin. Far away from the get-rich hype online. Support is simply a price level where buyers have repeatedly shown up and refused to let the price fall any lower. Every time the stock drops down to that level, a wave of demand appears and quietly pushes the price back up. Think of support as a floor, a place where the crowd has decided again and again that the stock is cheap. Resistance is the exact mirror image. A price ceiling, where sellers keep showing up to knock the price back down. Every time the stock climbs to that level, a wave of supply appears and quietly caps the rally before it runs. Think of resistance as a ceiling, a place where the crowd has decided again and again that the stock is expensive. So far, this probably sounds almost too simple, like something that could not possibly move billions of dollars around. But the reason these levels are so powerful has almost nothing to do with the lines drawn on the screen. The real power comes from memory, because the market genuinely remembers where people made money and where they got hurt. Imagine a crowd of traders who all bought a stock right before it crashed hard and trapped them in a painful loss. Those traders spend weeks just praying for the price to climb back up so they can finally escape at break even. Therefore, the moment the price returns to that level, all of those trapped people rush to sell and get out. And that flood of desperate selling is exactly what creates an invisible ceiling of resistance at that price. Now flip the story completely around to see the other side of this same emotional coin. Imagine another crowd who watched a stock bounce hard off a certain price and rocket upward before they could buy in. They spend the next few weeks wishing they had bought that bounce, kicking themselves for hesitating at the perfect moment. Therefore, the second the price drops back to that level, all of those regretful people finally jump in and buy. And that flood of eager buying is exactly what creates an invisible floor of support at that price. This is the honest heart of the whole thing, the part the flashy gurus almost never bother to explain. Support and resistance work because they are a map of raw human emotion, painted in real money on a chart. They are the fingerprints of every regret, every trapped loss, and every missed opportunity the crowd has ever felt. But there is a second, sneakier reason these levels hold, and it turns them into a kind of self-fulfilling prophecy. Nearly every serious trader on the planet is staring at the exact same obvious levels on the exact same charts. So when the price approaches a level that millions of people can clearly see, they all react in roughly the same way. Buyers place their orders at support because they expect a bounce, and that very expectation is what causes the bounce. Sellers place their orders at resistance because they expect a rejection, and that very expectation is what causes the rejection. In other words, the level works partly because a huge crowd of people all believe that it is going to work. This is precisely why a beginner can draw one clean line and watch the price respect it almost like magic. There is a strange comfort in that first moment, when the chart suddenly feels readable instead of random and chaotic. For the first time, the beginner is not just guessing, they are seeing the actual footprints of the crowd on the screen. But that comfort is also the exact trap that lures so many people into betting far more than they can afford to lose. But here is where the story takes its first real turn, and where most honest teaching quietly falls apart online. No level holds forever, because eventually a wave of pressure arrives that is simply too strong for that floor or ceiling. When the price finally smashes straight through resistance, Traders call that moment a breakout, and the whole picture changes. Suddenly, all those trapped sellers are gone, the ceiling has shattered, and the price is free to run into open air. But then something beautiful and strange happens that reveals just how deep this memory in the market really goes. That old resistance level, the ceiling that just broke, very often flips around and becomes the new floor of support. The price will climb, pause, and then fall back down to retest that exact same line it just broke through. And instead of getting rejected there like before, it now bounces cleanly off it and continues marching higher. Traders call this role reversal, and it is one of the most reliable behaviors on the entire chart. It happens because the crowd that once feared that price now sees it as safe, and their emotions have completely flipped. So a single line on the screen can be a ceiling one week and a floor the very next, purely because of psychology. Now, a beginner watching all of this might reasonably conclude that they have finally found a guaranteed money machine. Just draw the lines, buy at support, sell at resistance, and ride the breakouts, all the way to being rich. But this is exactly the dangerous fantasy that quietly destroys thousands of new trading accounts every single year. Because support and resistance do not tell a trader what is going to happen, they only tell a trader where to pay attention. And that difference between where and what is the entire line separating the survivors from the people who go broke. The first brutal reality is that these levels are not thin, precise lines. They are actually messy, blurry zones. A trader might draw resistance at exactly $100, but the real ceiling could be anywhere within $1 of that. So the price can spike right past the line, hunt down a bunch of stop-loss orders, and then snap back down. Traders call this a false breakout or a fake-out, and it is one of the most painful traps in the market. It feels like a clean breakout, so the crowd rushes in to buy. Therefore, they get trapped at the very top. And then the price collapses back below the level, leaving all those eager buyers holding an instant, ugly loss. Even worse, the biggest players in the market actually know exactly where all those obvious stop-loss orders are sitting. So sometimes they deliberately push the price just past the level to trigger those stops before running it the other way. This is not a conspiracy theory, it is simply how liquidity works when big money needs to find willing buyers and sellers. Which means the very obviousness that makes a level powerful is also the exact thing that makes it easy to exploit. This is why two traders can look at the identical chart and the identical level, yet walk away with opposite results. One of them treats the line as a certainty and bets the farm, while the other treats it as a possibility and protects themselves. So the honest truth is that support and resistance give a trader an edge, but they never, ever give a guarantee. A pattern can tilt the odds in a trader's favor, but it can never remove the risk of being wrong. Any single trade, no matter how perfect the setup looks, can still fail completely and hand the trader a loss. And this is the exact moment where almost every beginner asks the wrong question and heads down the wrong path. They ask how they can find a pattern that wins every single time when no such pattern has ever existed. The professionals ask a completely different question, one that quietly separates them from the 90% who lose their money. They ask how much they will lose if they are wrong, and how much they will make if they are right. This is the concept of risk and reward, and it matters far more than any pretty pattern on the chart. A trader can be wrong on more than half of their trades and still walk away deeply profitable at the end of the year. Because if every loss is small and controlled, and every win is allowed to run much larger, the math quietly takes care of itself. This is the part that feels almost backwards, because most people assume that winning traders must be right most of the time. But being right is not the same as making money, and being wrong is not the same as going broke. What actually matters is how much a trader risks to find out whether the market agrees with them or not. Support and resistance are simply the tool that tells a trader where to place that small, controlled stop loss. A trader buys just above support and places their exit just below it, so their risk is tiny and clearly defined. If the level holds, they win big. And if the level breaks, they lose small and simply move on to the next trade. So the pattern was never really about predicting the future. It was about defining the risk before the trade ever began. That is the boring, unsexy secret that the honest professionals understand and the loud online gurus almost never mention. The chart pattern does not make the money, The risk management wrapped around that pattern is what actually makes the money. The best traders treat every level as a place to ask a question, not as a promise of a certain answer. They know that a floor is only a floor until the day it isn't, and they always plan for that day in advance. They stay humble, they keep their losses tiny, and they let the odds slowly grind out a profit over hundreds of trades. And this brings the whole story back around to that one deceptively simple pair of lines from the very beginning. Support and resistance are the only chart pattern that truly matters because they reveal the one thing every other pattern is built on. That one thing is the crowd. The living, breathing mass of human fear and greed hiding behind every candle on the screen. Because in the end, a trader is never really trading a stock, a chart, or a clever little pattern at all. A trader is always, quietly, trading against the memory, the emotion, and the predictable regret of every other person in the market.